Welcome to our new video, where we will discuss draw on liquidity in detail. First, let's explain what draw on liquidity is. In simple terms, we see it as a way to predict future market movements and determine how far the market can go. To understand draw on liquidity, we first need to grasp external liquidity and internal liquidity. Let's start with external liquidity. We define external liquidity as the old highs and old lows in the market. These are what we call external liquidity. Now, what is internal liquidity? We consider internal liquidity to be imbalances in the market. For example, if the market moves up and then comes back to fill the liquidity of a fair value gap, FVG, that's what we refer to as internal liquidity. Let's explain this with a diagram, and then we'll look at it practically on a live chart. Consider this a 4-hour chart. Here, we can see the market following an uptrend. But what did the market do? We observed that it first created a high. Above this high is what we call external liquidity. So, what did the market do? We noticed it hit an old high, which represents external liquidity. The market filled this liquidity here, pointing to the chart, as we can see at this arrow. Then, it moved upward. When the market fills external liquidity, we often see it come back to fill internal liquidity, which is an imbalance, such as a fair value gap. We observed the market filled the liquidity of the FVG and then moved to fill another external liquidity. In an uptrend, we typically see the market fill external liquidity, then internal liquidity, and continue this cycle of external to internal to sustain the uptrend. So, what do we understand here? We see the market filled external liquidity and then came to fill internal liquidity. Since the market is in an uptrend, we can predict that it will likely move straight up from here. Why? Because external liquidity is present, and in an uptrend, we know the market continues its rally from external to internal liquidity. So we predict the market will likely move upward here. This is what we call draw on liquidity. We've already predicted that the market will move up to fill this external liquidity. This is a 4-hour chart, but we could also catch the uptrend on a 1-hour, 5-minute, or 15-minute chart. What we've identified here is the draw on liquidity, where the high, external liquidity, becomes the draw on liquidity. We believe the market will likely move upward next, not downward, because it's in an uptrend. From this, we learn that old highs and old lows are key levels with significant liquidity, and the market tends to follow these levels. For example, we saw an old high, and the market filled it. There was another old high, and we saw the market fill that too. There's another old high here, and we expect the market may come to fill it as well. This is how we make future predictions. Now, let's remove this and explain further, so we ensure everyone understands that the market will move up and fill this external liquidity, which is the draw on liquidity. Let's show another scenario. If this is a 4-hour chart, and let's say there's a 1-day order block here, we'll mark it as an order block in this section. So we can see there's a higher time frame point of interest. Let's call it a 1-day order block. We noticed the market tapped it. Since the market has already filled the liquidity of this 1-day order block, what will be the next draw on liquidity? We think it could be this low or that low. However, we won't consider this low because it's within the range of another low, making it internal liquidity. But this external liquidity, an old low, will be our draw on liquidity. In the future, we expect the market is likely to come to this level. So, what can the market do? We think it might dump to collect this liquidity, then take internal liquidity, and dump again. For example, we might see the market dump, collect this liquidity, and then move to a balanced price range BPR. Let's mark it as a BPR here. After that, we expect the market may move up, collect external liquidity, then internal liquidity, and finally collect the draw on liquidity. So, we hope you understand what we're trying to explain. We observed the market started a downtrend here, shifting from an uptrend to a market structure shift, MSS, and continued its downtrend. This is what we mean by draw on liquidity. We can predict where the market is likely to go and which liquidity it will target. Let's look at the best example. Here, we had a BPR, but it could also be an FVG. We usually consider an FVG as internal liquidity and old highs, old lows as external liquidity. So, we'll mark an FVG here. We saw the market showed a reversal from a higher time frame, took the liquidity of this low, dumped, and then moved further. Let's explain one more thing. Here, we noticed the market created a structure, and it's in a downtrend. Now, it wants to move upward. So, what's this upper part? It's external liquidity. We'll mark it as external liquidity here. We expect the market will come to fill it, but there's also an internal high in between, which is another form of internal liquidity. The market doesn't ignore this, but we believe the draw on liquidity will be this external liquidity. For example, we predict the market will come, fill this external liquidity, take the internal high with a small pullback, and then move to fill the draw on liquidity. So, we understand that old lows and old highs are key levels, and we call them draw on liquidity because they are significant levels that the market always targets. We know these levels often have a lot of buy-sell stop orders placed below them, so the market comes to fill those orders and continues its rally. In simple terms, we see stop-loss orders at these levels, and the market comes to collect them before continuing its move. So, we hope you've understood what external liquidity and internal liquidity are. We observe that the market always moves from external to internal and internal to external to continue its rally. Now, let's look at an example. This is a 4-hour gold chart. Here, we see the market is dumping after an uptrend. So, which is the external liquidity? It's this low, which we'll mark as external liquidity. We noticed the market first left this external liquidity, then moved up. This FVG here is our internal liquidity. Let's zoom in and explain further. On a smaller time frame, we believe there was likely a structure shift here, and the market continued its downtrend. This FVG is our internal liquidity, which we identified as an imbalance. We saw the market dumped, collected internal liquidity, and then collected external liquidity. There was likely an order block or something here, and we observed the market collected its liquidity. We can call this an internal high as well. We'll mark it as IH, internal high, here. The market filled it and continued its dump. Let's explain one more thing. It's called institutional order flow. We'll mark it here. We saw the market dumped here, creating external liquidity below this low. So, we'll mark it as external liquidity. The market left this external liquidity, moved up, and came to internal liquidity, which is this range FVG. Within this range, there was a powerful part called institutional order flow. We observed the market filled it and targeted this external liquidity, which is the draw on liquidity. When the market was here, this was the draw on liquidity. So how did we predict this? This part was our draw on liquidity. Now, let's look at the latest example to see what the market might do and how we can identify the next draw on liquidity for gold. This external liquidity has already been filled, and gold is currently in a consolidation phase. We noticed the market has left external liquidity here, which it might come to fill. But before that, we expect it will likely fill internal liquidity. On this 4-hour chart, we'll mark the fair value gap. We believe the market will respect this FVG first. For example, it might move like this or like that, and then dump. The draw on liquidity will be this external liquidity. When the market falls from here, we think it's likely to reach this level quickly, unless it fills the FVG first. If it dumps directly from here, we see the overall downtrend will continue. However, we can consider this FVG as a high liquidity zone or a powerful liquidity point. We can predict that the market might behave like this in the coming time. This was an important concept of ICT's draw on liquidity, which helps us predict the market's next move. We hope you liked this video. See you in the next video.